Donald Trump's ever-changing tariffs, surprise interest rate decisions, the past year has been characterised by chaos and uncertainty, which is expected to loom large on the balance sheets of Australia's major companies.
What we've seen over the last 6 months is equity markets push on to new all-time highs, both here in Australia and offshore. But this has happened at the same time that the earnings expectations have been nudged down.
I think what the market's looking for is earnings growth for a start, because we have not seen enough of that, clearly, and also a catch-up to where share prices have found themselves.
As corporate Australia opens its books, the report card isn't expected to be rosy.
When you look across the ASX 200 index, profits are expected to fall by about 2% this financial year. Overwhelmingly, that's been driven by resource equities. When we look at mining and energy companies, they're seeing their profits fall by about 20%.
Rio Tinto's already revealed its profits were hit by weak iron ore prices, oversupply and slowing demand from Australia's biggest trading partner, China. The same pressures will weigh on BHP's and Fortescue's earnings. Also in focus, the results of the largest company on the ASX, the Commonwealth Bank.
Its performance over 12 to 18 months has been so extraordinary. If it disappoints in a meaningful way, that's going to have real ripple effects.
The capital return from the banks will be less than what it used to be. So I do think that sector is looking quite expensive.
The banking space is expected to see no profit growth into FY26, and it could be that what we've seen in that area of the economy is already as good as it gets.
With cost of living pressures and just 2 interest rate cuts this year, consumers have been reluctant to open their wallets.
The consumer space is in the back foot, healthcare are in a tough space. The interest rate relief that they expected this year to eventually help profits is not yet being seen, and therefore the analyst community is likely to push out further their earnings recovery stories.
Despite tough trading conditions, analysts still expect some good results.
The owner of Kmart and Bunnings and Target. Wesfarmers has performed really strongly over the last 12 months. JB Hi-Fi is up 60%. And a good chunk of that performance over the last 12 months has been the fact that analysts and investors were expecting really poor performance.
This reporting season will see more corporate concessions about the impact of US tariffs.
There's a couple of selective companies that gets impacted directly. For example, a company like Ansell or a company like Breville, where they do manufacture those products in tariff-affected countries.
You look at something like Lovisa with dramatic store rollouts. Is that going to be impacted? And then you look at a company like ResMed as well, which currently has an exemption from the tariffs.
While labour costs and inflation are putting pressure on margins, and a rate cut that failed to happen last month is dampening consumer sentiment, the outlook for the year ahead is expected to be more positive.
This will be interesting reporting season because it's likely to be the bottom of the Australian economic activity, probably one of the last bad results, if you like, because looking forward, things should get better.
Hopes of green economic shoots in a very uncertain world.